Some of the money habits you're relying on right now won't just be outdated by 2030, they'll actively cost you. Not because they were ever bad habits, because the systems around them are shifting fast enough that habits built for the old system start working against you in the new one. Financial researchers and fintech analysts track this constantly. Which behaviors are becoming obsolete as banking, credit, and income all move toward faster, more automated, more real-time systems? In this video, we're counting down 5 financial habits that current trends suggest are heading toward irrelevance by the end of the decade, and what to shift toward instead, while there's still time to adjust calmly instead of catching up in a panic. Let's start with number 5. Habit number 5, keeping a large cash cushion sitting in a basic savings account earning close to nothing just because it feels safe. This habit made more sense when moving money between accounts was slow and inconvenient, but as instant transfers and higher yield digital savings options become the default rather than the exception, leaving a large balance parked at near zero interest increasingly means quietly losing value to inflation every single month. This isn't a call to take on risk. Safety still matters. It's a call to notice that safe and stagnant are becoming 2 very different things. And by 2030, the gap between someone earning near zero and someone earning a competitive rate on the exact same emergency fund is expected to be significant. Habit number 4, treating a manual spreadsheet or paper ledger as your only method of tracking spending. There's nothing wrong with wanting hands-on visibility into your money. That instinct is good. What's becoming outdated is doing it entirely by hand in a world where automated categorization and real-time spending alerts are becoming standard, even in free tools. The habit itself isn't the problem. The all-manual version of it is what's fading because it takes significant time for a level of accuracy that automated tools now handle by default. Analysts following personal finance tools expect this gap to widen further by 2030 as automated tracking becomes as normal as automatic bill pay is today. Habit number 3, relying entirely on a single employer's retirement match as your whole long-term strategy without ever diversifying where else your money grows. This habit was built for a career model where people stayed at one job for decades. As more of the workforce moves toward multiple income streams, job changes, and self-directed investing, a retirement plan anchored to just one employer's plan becomes a lot more fragile. One layoff or one company change, and that growth engine can stall out entirely. This doesn't mean the employer match is bad. It's usually free money and worth taking. It means treating it as your entire plan rather than one piece of a broader one is the part of this habit that's losing ground. Habit number 2, only checking your credit score once a year, if at all, and treating it as a background detail rather than an active number. As lending increasingly shifts toward more real-time and dynamic financial data, not just a once-a-year snapshot, staying unaware of where your score stands for months at a time means finding out about problems only after they've already cost you, whether that's a denied application or a worse interest rate than you could have gotten. This habit is fading because the tools to check in real-time for free are becoming standard in most banking apps. The habit that's becoming outdated isn't having a credit score. It's not looking at it. And habit number 1, the biggest shift researchers are tracking, relying on a single income source with no digital or portable skill behind it. This isn't a call to quit your job or start a business tomorrow. It's a recognition that as more of the economy moves toward flexible, hybrid, and multiple income arrangements, having zero backup income stream is becoming a riskier position than it used to be. Not because jobs are inherently less stable, but because the definition of financial security is quietly shifting to include some form of income flexibility. By 2030, analysts following labor and gig economy trends broadly expect having some kind of secondary or portable income skill to move from nice to have towards something much closer to a financial basic. Starting small now beats scrambling to build one later under pressure. So to recap all 5, parking cash in a zero-interest account, tracking every expense entirely by hand, relying on one employer's match as your whole retirement plan, checking your credit score once a year or never, and depending on exactly one income stream with no backup skill. None of these make you bad with money today. They're simply habits built for a system that's shifting underneath them. And the earlier you notice which ones apply to you, the more room you have to adjust gradually instead of scrambling later. If a few of these sound familiar, here's where to start adjusting one at a time. 1. Move idle cash into a higher yield account. This is usually the fastest, lowest effort fix on the whole list. 2. Let one automated tracking tool run alongside whatever manual system you already trust, rather than replacing it overnight. 3. Open one additional retirement or investment vehicle beyond your employer match, even with a small amount, so your growth isn't tied to one source. 4. Turn on real-time credit monitoring in whatever banking app you already use. Most of them offer it for free now. And 5. Treat building even one small portable skill as a long-term project, not an emergency reaction. None of this requires overhauling your entire financial life this week. It just requires knowing which habits are quietly aging out so you can update them on your own timeline. I'm Zyra, a research presenter, not a licensed financial advisor or futurist. These 5 points reflect general trends discussed by financial and fintech analysts, not guaranteed predictions, and your own situation may shift differently depending on your circumstances. For guidance specific to your finances, a licensed financial advisor is always the better resource than any forecast-style video, including this one. If you nodded at 2 or 3 of these, drop the number in the comments. Want to learn how to build a portable income skill from zero? Subscribe. More on that coming soon. Thanks for watching, and I'll see you in the next one.